Hi everyone. Today my topic is interim period reporting. As some of us are preparing quarterly provision, I'm going to discuss some items excluded from ordinary income. We have discussed some of the discrete items in the past. Now I'm going to list you some examples of discrete items that I think is important. Although most items fall within the definition of the ordinary income, there are also items that should be excluded from the definition of ordinary income. We heard the term discrete item quite often. It's a term from ASC 740. It means the items that are not common and infrequent in nature and should be excluded from the estimated annual ETR calculation. In some cases, the standard is clear to exclude some items from ordinary income. In some other cases, judgment will be necessary to identify discrete items with certain instructions. The estimated annual ETR approach should only be used to record the tax effect of ordinary income for the period. Here is the list of possible items that need to be excluded from ordinary income. Significant, unusual, or infrequent items. Discontinued operations. Change in accounting principle. Tax-exempt interest, investment tax credit, income from equity method investments, change in uncertain tax position, interest and penalties, change in tax law or rate, change in tax status, change in valuation allowance, indefinite reinvestment assertion, change in estimates related to prior year tax provision. An item does not need to be both unusual and infrequent to be excluded from its estimated annual ETR calculation. Deciding whether an item is unusual or infrequent is an area of significant judgment, and company's business model may be relevant to the evaluation. For example, losses resulting from annual disasters, such as typhoon, are not unusual or infrequent for property and casualty insurance companies because those companies are in the business of insuring customers against those risks. However, the loss from a typhoon may be unusual or infrequent for a manufacturing company. Tax-exempt securities often form a portion of ordinary income of an entity. The related interest may be appropriately considered in the annual ETR calculation. However, it is also okay to exclude tax-exempt interest from an annual ETR based on a specific discussion in FASB interpretation. The FASB acknowledged of the excluding tax-exempt interest from the estimated annual ETR calculation. However, which approach is selected should be applied consistently. A change in estimate in the current year that is related to a prior year tax provision does not constitute a tax effect of current year income. That means the effect of this type of change should be recorded as a discrete item in the quarterly provision during which the change in estimate occurs. The existence of a new information that results in a change in judgment that causes subsequent change in measurement of a tax position taken in a prior annual period should be recognized as a discrete item in the period the change occurs. For example, if a court case in the interim period prompted a change in the assessment of the sustainability of a tax position taken in a prior year, the effect of the change should be recorded discretely in the period in which the assessment changes. The need for a valuation allowance must be reassessed at each interim period. Under the guidance in ASC 740, and depending on the circumstances that lead to a change in the valuation allowance, the change may be reflected in the estimated annual ETR or recognized discretely in the interim period during which the change in judgment occurred. Lastly, interest and penalties should be accounted for discretely as they occur since they are not related to the ordinary income. ASC 740 requires accrual of interest on the liability for unrecognized tax benefit from the first period in which the interest would begin accruing. That means interest expense should be accrued as incurred and should be excluded from the estimated annual ETR calculation. ASC 740 also indicates that a penalty should be recorded when a tax position giving rise to a penalty is taken or anticipated to be taken on a tax return, or when the entity's judgment about whether the position gave rise to a penalty changes. That means penalty should also be accrued as incurred and should be excluded from the estimated annual ETR calculation. That's it. Thank you.